Investor panel.
Good morning, everyone. I'd like to welcome our panelists to come on up. What I'm going to do is I'm going to do since we're limited on time, we're a little over, so I'm going to move a little quick. I'm going to introduce each of the panelists, have them talk a little bit about the size of the deals that they work on and what their industry focuses are, and then we're going to be discussing their feelings about the presenters. And then we're going to talk about industry trends, and then we're going to open it up for a Q&A. So I'm going to open up with Richard Baum. I'm going to give a brief intro on Richard. Richard is a founding partner of Consumer Growth Partners. Prior to founding CGP, he spent over 15 years as one of Wall Street's leading equity research analysts covering the specialty retailing sector at Credit Suisse First Boston, Goldman Sachs, and Sanford Bernstein. He was consistently ranked at the top of the annual Institutional Investor and Greenwich Associates polls for most of his years on Wall Street. Mr. Baum led 9 initial public offerings and 6 secondary offerings for many retailers, including Abercrombie & Fitch, Build-A-Bear Workshop, Cabela's, Gymboree, to name a few. So Richard, I'm going to open this up. Why don't you tell us about the deal sizes and a little bit about Consumer Growth Partners.
Sure, thanks, Corey. So I moved into the world of private equity in 2005 and founded a firm called Consumer Growth Partners. We are what's known as an independent sponsor, and that means that we do not have a fund per se, but we find interesting opportunities and do them on a deal-by-deal basis, and we fund them with a variety of institutional capital partners. We focus exclusively on investing in specialty retail and what we call non-perishable branded consumer products. So we don't do food and beverage or anything that's got a shelf life or an expiration date. Our sweet spot are companies that have somewhere between 2 and 8 million of EBITDA. We're capable of investing in businesses that are much larger than that, but we like to have proven concepts. And we very much like investing in family businesses where either the founder or the family has been in it for a long time, kind of done their thing, if you will, and either want to exit or don't want to put more capital into the business. We've got 6 portfolio companies at the moment and 2 more under LOI.
Thank you, Richard. Our next panelist is Paul Homer. Paul joined Northwood Ventures in 1999 after serving as a financial analyst for a venture capital finance retailer with over 80 stores. While there, he evaluated various capital raising alternatives for the rapidly growing firm and developed a financial reporting system. In addition to reviewing new investment opportunities, Paul serves on the board of several of Northwood's portfolio companies, including he was a Leica board member for a long period of time. Paul.
Sure. Northwood Ventures is a $150 million private equity fund headquartered here on Long Island. We are focused primarily on wireless communications, restaurants, retailing consumer products, and financial services companies. We're typically investing between $4 to $8 million of equity per transaction, and doing both venture stage deals and later stage buyout opportunities.
Thank you, Paul. Our next panelist is Shamid Mehta. Shamid joined Susquehanna Growth Equity in 2011. He is responsible for originating and evaluating investments in software, healthcare IT, information services, and security sectors, and worked on SGE's investments in HMP Communications, MMIT, Skybox Security, and Verisafe. Prior to joining SGE, Shamid was an associate at the private equity firm Great Hill Partners. Shamid?
Thank you. Susquehanna Growth Equity is a really unique investment firm. We get funded by Susquehanna International Group, which is a large financial services firm. Apples to apples with other private equity firms with 4,500 million. We get that one sole LP, so we never have to fundraise, and we have very good capital behind us. It's very unique to the industry. In terms of sectors, I focus and the team focuses focuses on software, internet, and information services. We look to invest between 5 and 50 million in equity in any given deal. And typical deal sizes for us or companies range from revenues of 5 million at the low end all the way to about 150 million at the high end. We're not as sensitive to EBITDA, positive or negative. And we really will look for anything from traditional growth equity deal to small buyouts.
Thank you, Shaman. Our next panelist is Peter Petrillo. Peter Petrillo is a senior managing director at Wafra Partners. Mr. Petrillo has spent his entire career with middle market companies as a private equity professional, consultant, and an accountant. We move out of the accounting firm. Prior to joining Wafra Partners, Mr. Petrillo was a partner at Claymore Partners, where he worked as a turnaround manager and a strategic planner for corporate clients. Peter?
Hi, Wafra Partners, private equity group. We invest in companies with revenue between $20 and $120 million, EBITDA of 4 to 12 million. 40% of what we've done over the years have been consumer products, so one of the reasons I'm here. Another 40% is in outsourced business services, and 20% is spent with things like niche manufacturers, some sort of specialty service companies. Very growth-oriented, like industry consolidations, particularly fragmented industries, where we could buy a group of companies, amalgamate them, and hopefully sell them to at a higher price to a larger buyer.
Okay, so as you can see, we have a, from a small to a larger stage group of panelists, so we can get a perspective of different stages and what companies should be looking for. So the first thing is really, now that we've seen our presenters, I'd love to hear your opinions as to some feedback, some high points that you saw, and some suggestions that you may be able to give them. Richard?
Sure, I'll start. I guess it's always bad to have a letter at the beginning of the alphabet for certain things. This being one of them. I think, you know, on the positive side, the one thing that I really liked about all the presentations, and this is something that we often look for, is a very targeted niche business. It's really the only way that you can be successful if you're in the lower middle market, if you will. One of our kind of gating questions that we always ask is whether there's a competitor, either a current competitor or some future competitor or set of competitors that we can identify. They could put the company out of business if they wanted to. Might not be so nice with the Justice Department, but if that risk is there, we pretty much walk the other way. And I think with all the companies that presented, I think each of them made a pretty compelling case that, you know, their success or failure in the market would largely be due to the way they execute the business and their business plan, and we generally like to see that in all of our companies as well.
I'll switch it up since you don't want to go by alphabet.
Fine.
Shaman. I'll let you off.
I think all the presenters did a fantastic job of presenting their businesses. I think it takes a lot of courage to come up here and to talk about the business that you spend so much time on. So good job all around there. Areas that I look at, businesses that I evaluate, are sort of businesses that have high recurring revenues are something that's really important to me. I think those in industry or sort of what we're seeing in the market drive higher valuations. Building operating leverages in those businesses also command higher premiums in valuation. So in large markets, right? Those are three things. If somebody asked me today, hey, you only see three things in the business, those are probably the three things that we are really focused on and try to understand. I think all the presenters did a good job in their respects of describing their business model.
Okay. Peter?
I'm a little out of my element because we invest in more mature companies, but I have sincere admiration and respect for those that start businesses like those that were presented today. And we love buying these businesses from these people that have had the passion, went through the trials and tribulations to build them. We like the stories, we like working with them, we like to help them go to the next level once they get to a size that makes sense to us. but you're frankly just not smart enough to understand what happens from here to there. That's why we invest in latter stage private equity, and we don't get involved with venture capital. We tried it once with Paul and his friends at Northwood, and neither of us came away too happy on that one. So we're just not smart enough to figure out, is the product going to work, people are going to pay for it, they're going to make some margin on it, they're going to be able to develop the infrastructure, will they develop the systems necessary. We just don't have that vision, but I have the utmost respect for people that actually that's the board.
Well, I'm going to come back to you on that in the second part of the Q&A that we're going to go through. But yeah, because we want to hear your perspective when they mature. So, Paul.
Sure, I think I echo everyone else's comments up here that, you know, the presenting companies do a fantastic job. I think they're all addressing very interesting markets. And I think the most important thing I look for in a company is the management team, and making sure that the management team has sufficient experience, has probably led a startup or run a company before. It's always tough to back up first-time CEO. And backing a great management team is better than backing a great company, because the management team can usually, that's excellent, can usually switch their strategy quickly and react more quickly to a changing market and make the company more successful.
Yeah, great.
Yeah, Corey, I just want to make one point, because I think we've all been very positive, kind of feel the same way about the companies that presented, but to provide some constructive feedback. We generally, when we look at plans, and we all see a lot of them, a lot of times, most of the time, the projections are kind of pie in the sky. And in order for a company to really hit the projections that they're putting in front of us, it's kind of everything has to go right. And it's probably more common to see something like this, I would guess, in really early stage companies. But when I looked at pretty much the projections across the board, we would probably be discounting those by maybe 50% or more. They just seem really unrealistic to me, given particularly what Peter said, with regard to the infrastructure that you need to have in place in order to execute these things successfully. And I would just encourage people that if you are going to show numbers like that, you need to have them backed up kind of 8 ways to Sunday, because you're going to be really questioned intensely about your ability to reach those numbers.
Would you call that the X factor, partially?
Well, as a big fan of the X Factor, I would say absolutely.
Shami, what's your take on that? So,
In terms of
we'll call it the X factor, the management team, the things you look for, the criteria.
one of the things we spend a lot of time on is markets. We want to make sure, I guess when we constructive criticism, everybody has competition. If you tell me you have no competition, tell me you haven't worked hard enough, and I have to work hard to find competition. So I spend a lot of time understanding landscapes, understanding both horizontally and vertically how your product or how your solution or business reacts in the environment with large, smaller, adjacent, and substitute products.
So let's go to that. We had two or three presenters that are in real consumable food products, going to market. All right. What would what was the feedback that you saw, and what needed to be addressed that if you were to go to due diligence to look into them, what would you be looking at in some of those companies? Paul?
Sure. I think probably just sort of take the Powerful Yogurt, because I have a lot of experience, and Northwood has a lot of experience in the healthier living and food space. But I think one of the key factors there would be to look at Powerful Yogurt's distribution and understand from their sales how much of the sales are coming from what we call pipeline fill. They've got roughly $1 million in sales. How much of that $1 million is just the product that's going onto the shelves? And then what's the sort of comparable door sales? How much yogurt is actually selling per door for the retailers? And then you want to compare that to the other brands out there and also understand what the company's doing to sort of work with the buyers in the grocery stores and food stores to get on the shelf. And you know, the refrigerated space is a very difficult space because you've all been in grocery stores. There's only 1 or 2 aisles of dairy products in the stores, so you've got to displace another competitor in order to get shelf space. And you have to prove that your sales per point of distribution are going to be higher than the competitors in order to get that space.
Anybody else want to grab the mic?
I mean, I don't want to pick on the yogurt company, but one of the first things I would do is look into that go-to-market branding strategy. My gut is it's the wrong one, just my gut. And I'm not great with these early stages.
No pun intended.
The gut.
Yeah, the humor thing didn't get me. I'm not sure if that's going to really connect with people, but I'd love to do some studies on that and get some consumer feedback and retailer feedback, distribution feedback to see if that's connecting with people. Sweet Amanda, by the way, just to segue a second, I mean, I have some experience with a coin-based business. It's called CPM. We do kitty rising balls and penny presses, and we do some candy. And you're going to have many more costs than you're forecasting, just based on our experience, and you have a lot of vending experience also. So to Richard's point, in terms of a forecast like that, and sometimes it works against us as investors when we have some knowledge. It's not always good, because ignorance can be bliss. When you have some knowledge of something, then you see a forecast like that, I would then turn it off a little bit, because it's just not possible based on experience.
Anybody else want to chime in? Because I got another question.
Yeah, I'll just take a shot at it. You got talked about the 3 different, let's call it food-based businesses. The one, actually, I kind of like Powerful Yogurt. The other 2, Sweet Amanda's and Let's Order Now, are really kind of just changing in a delivery system of products that have already been around for many, many years. So there's nothing, nothing particularly new about it. And I guess you have to really understand how often new delivery systems actually are successful. And there are many examples where there are, and I think you guys in Sweet Amanda's put up a number of them. What I liked about the yogurt business is that it was differentiated. It was clearly, I like the idea that it was addressing a different market that clearly is one that a lot of people have not addressed, which is the male market. We do a lot of work in apparel, and we love it when we find a business that is a male-oriented business that has not addressed the female market, because females are such big consumers of apparel. Kind of the same analogy there.
Anybody else want to chime in? All right. So now my question is, we've spoken about, right now we just spoke about the food companies, but let's go to the fact that, what do you see when you look at presentations that's, your positives and negatives? You kind of hit upon a few of them, but, what's the trends of what you're seeing in the companies looking for funding these days? Anybody want to grab it?
I just don't do that.
No, let's go to your area, not at this level, let's go to your area.
In my area, there's an abundance of money. I mean, there's a huge amount of private equity overhang. Debt is readily available, and they're clamoring over each other to do deals. I know maybe not at a certain size, but when I'm talking about in my world, companies doing $40 to $100 million of revenue and the type of profitability I'm talking about, lenders are clamoring over each other. Mezzanine lenders are reducing rates to get opportunities. There's a lot of private equity. Strategic buyers are very active. They're having a tough time getting revenue and margin growth. So somebody is putting forth an edict to do something. So they're acquiring. We're selling 4 businesses because this is a big seller's market. It's hard to buy a reasonable price right now to generate the types of returns that we normally do.
What if, speaking to that, and I've seen it too, how percentage-wise, what do you say the EBITDA multiples have gone up over the last 2 years?
Well, I'd say it's gone up 20%. So something that might have gone for 5.5 times, is now getting close to 7, which is very cool.
Great. Maybe even a little higher in some specialty industries that have attracted interest lately.
We have a testing company that will bring market testing, inspection, certification. We bought it for 6.5, 7 bids we have, which are numerous, or 9.5, 10 calls for it. So certain industries where it's really attractive, the dynamics are really getting priced high.
What is everybody's feeling regarding, is this a cycle and how long would that cycle last? That's, because you're going to market with these companies, you know it's the time. Anybody want to grab that one? And nothing science, but just, get a